Good morning. Welcome to the Genghis Weekly Investor Briefing. And in this briefing, we engage our research department in discussing the industry, that's the financial industry news in the past week and what to expect in this new week. And this is brought to you with the aim of enabling you make sound financial decisions in this coming week. So with us, we have Churchill Ogutu, who is the head of research at Genghis Capital and is flanked by Melody Ndanu and Wesley Manambo, both of the research department. And they'll be taking you through the presentations today. So should you have a question, you can direct it down at the Q&A section or the chat section, and the questions will be answered right after the presentations. So over to you, Churchill.
Thanks, Dan. Good morning, everyone who's joined us. So as usual, I'll take you through the macroeconomics section and then get into the fixed income before my colleagues finish off with the equities segment. So I'll start with the macroeconomic review. This is for last week. We start with the Kenya Gazette issue. Basically, they gave a statement of revenue and also the net expenditure highlights. And in terms of ordinary revenue, based on this report that was in the Kenya Gazette last week on Friday, we saw that ordinary revenue came in at 122 billion, which comprised of tax receipts at 121.8 billion, and then the other non-tax receipts at 349 million. So that was the performance for the month of July. But if we go back as far as 3 financial years ago, we've never seen July tax receipts this quite heavy at 120 billion. The most we saw, I think it was 2 financial years ago, which was around 107 billion. So this is quite an outlier, but nonetheless, it's still in line with the trend that we've seen in the current calendar year, starting from Jan, whereby month on month you've seen heavy tax receipts. So that is just a continuation of what we've been seeing in the course of this year. The other issue that we saw is in regards to the gross domestic borrowing, which came to 119.7 billion. That's partly comprised of TAP sale, the TAP sale that was for the June primary sale. It was concluded in the month of July. It raised 7.4 billion. And then there was a July primary bond sale, the 3 bonds that were on offer last month, another 79.9 billion. So collectively, it was coming to roughly 118 billion thereabouts. So the difference was now from other non-government securities as part of the gross domestic borrowing for that particular review month. Expenditure, we just saw money is being spent for recurrent expenditure. Recurrent expenditure as wages and also operations and maintenance costs. That total 71.2 billion. No monies were spent for development spending and also disbursement to county government. So there were nil disbursements in that particular month. Public debt, servicing of the public debt, with interest payment and also the debt redemptions, that total 89.3 billion. And as a percentage of the ordinary revenue, which we saw earlier on was 122 billion, that came to 73% of ordinary revenue. So for every 100 shillings that was collected in ordinary revenue, 73 was now to service the debt for that particular month based on this statement. Getting on to the next page, we look at the monetary statistics. This also was published in the course of last week. So on the left side, we look at some of the statistics, basically private sector credit stock. This is derived from claims on private sector, which is claims on banks and non-bank financial institutions, and also claims on CBK. So it was coming to around 2.981 billion. That's the total claims on the private sector. So reducing interest in suspense on the non-performing loan accounts, that's coming to around 80 billion. That gives us a private sector credit stock at 2.9 trillion as at the end of June. And then comparing on a year-on-year comparison, that is where our 7.7% is coming about. So we've seen private sector credit stock, private sector credit growing 7.7% in the 12-month period ending June 2021 to 2.9 trillion. But then again, if I take you back to, there's a policy document, monetary policy statement by the CBK, where it gives its estimates on where private sector credit will be throughout the next 12 months. So for the end of June, they were looking at a number of 8.5% for that particular month of June. So clearly at 7.7%, we're seeing that this particular private sector credit is more or less punching below its weight. It's not even hitting the target that CBK would like it to hit. So we are actually doubtful or cautious in terms of the trajectory of this particular metric, even in the current financial year. The left side of it is now some monetary statistics, but now I'll just look at non-bank holdings of government papers. That's like the second last column, row rather, second last row, where we've seen that there's a 23% increase in non-bank holdings of government paper. That's the securities in the last 12 months to 1.8 trillion shillings. So collectively, if you look at the overall liquidity, we've seen a close to 11% year-on-year growth in this particular metric to 5.9 trillion. So that also more or less ties to the theme that we've been talking about, high liquidity, but we'll be able to revisit it at some later slides. So let's now get into the fixed income. This week, we don't have anything that is scheduled in the macroeconomic calendar, but nonetheless, I think we're just expecting the release of the quarterly economic and budgetary review should be out sometime this week. But apart from that, there's nothing that has been scheduled to be released in the course of this week in terms of the Kenya macroeconomic indicators. So getting into the fixed income, last week, we saw a secondary market turnover more or less steady as compared to the previous week at 20.9 billion. The activity was majorly focused on the infrastructure bonds, IFBs, which accounted for over 50% of the week's activity. We don't think that that will spill over to this week because that was concentrated in a few names. So we just see that now we could see a normalizing of activity in the course of this week. Weekly T-bills plateaued to a performance rate of 29.3%. That was the lowest performance since late March period at an aggregate bids that were received of 7 billion shillings. We saw a slight uptick in the 91-day and 182-day tenors. This has been the recurring theme, I think, the last 2 or 3 auctions, and more or less pointing to an inflection point. I remember that between May all the way to July period, there was a sharp deceleration in the yields. But now we've seen, at least on the 91-day, 182-day T-bills, there's been like starting to point out north. And for 364-day tenor, it remained mute at 7.4% as per the week's auction results. Moving on to the liquidity indicators, interbank rate declined negative 0.44% week on week to an average of 2.75%. The other liquidity indicator is now the open market operations. This is basically CBK coming into assess on a daily basis liquidity needs for the bank in the banking sector. If there's need to mop liquidity or if there's need to inject liquidity. And because of the excess liquidity that we've been talking about, last week they came in to mop through 4 and also 7-day term auction deposits, the TADs. So bids that were received and also accepted totals 96.85 billion at a weighted average rate of 5.339%. Net domestic borrowing, as per our calculation, this is the government securities, is around 172.3 billion, and that represents 26.2% of the target at this point in time. We are ahead of the curve just based on these calculations. So just a walk through the results that came out last week for this month's primary bond sale. The target was 60 billion. Bids received was 104 billion, 105 billion. That represented close to 174% performance rate. Total bids accepted was 80 billion. So that implies that CBK, as the fiscal agent, exercised a green shoe option of 20 billion, bearing in mind that the target amount was 60 billion. So the 20 billion in excess was now the green shoe option. The results are more or less in line with the expectations, our guidance that we put out in last week's presentation, and also the August primary bond auction note that we published at the previous Friday. So it came in line with the expectation, and we are seeing data for FXD3 2019-10 weighted average rate higher than the coupon rate. So right now, the pricing is at a discount. So this is actually the clean price, not the data price. Is at a discount. Specifically for this paper, FXD3 2019-10, we are seeing that the semi-coupon payment bond pays coupons every 6 months. Its semi-coupon payment is actually being paid today, so it has not been trading. I think it was book closure was closed sometime late last week up until today, and then it will resume trading tomorrow. So it will start trading as quote unquote a new bond, but we know that it's a paper that has been trading for the last two years, and yeah, it's clean price it's priced at a data price. FXD1 2018-20, it's weighted average rate slightly lower than the coupon rate, 13.187% against coupon rate of 13.2%. So it has a slightly higher premium. It has a slightly higher price. For every 100,000, you'll find yourself paying 105,000 shillings. And now the new paper, more or less priced at par, because the weighted average rate is now the coupon rate at 13.44%. And now that takes us to our week's trade. For this particular week, we are looking at an attractive entry point on FXD4 2019-10, between 12.15% to 12.2%, basically the market rate. We are looking at this trade from the perspective that for FXD3 2019-10, 15.3 billion were rejected in last week's auction. If you compare to the other papers, I think the rejection was something in the order of 4.5 billion between the two papers on average. But now for this FXD3 2019-10, a significant 15.3 billion was rejected. So that will spur interest in the short-term and also the medium-term papers. And specifically because FXD3 2019-10 and also FXD4 2019-10 are more or less the same duration. Basically, they were issued in 2019 with 10 years in their shell life. So more or less having similar duration. It's only that now this specifically FXD4 2019-10 has a higher coupon rate as compared to the FXD3 2019-10. So that makes it that even the duration, it will lower the duration. By duration is that risk of in the event that interest rates go up, at least that FXD4 2019-10 paper will have a slightly lower duration compared to the FXD3 2019-10, by the virtue that its coupon payment is higher than the previous paper. So that's our week's trade. And now I'll hand it over to either Wes or Melody to walk us through the remainder of the presentation.
Good morning to you. Let's have a look at the activity in the bourse during the past week. The market was mixed as signaled by the benchmark indices. The Nairobi All Share Index was up 1.5% week on week, while the NSE 20 declined by 0.7% to close at 1961.07. Volumes were up 64.6% week on week to a turnover of 2.5 billion. On the top gainers, we had the Bank of Kigali Group leading the pack with about 18% week on week rally. The counter closed the week at 38 shillings and 25 cents, and it touched a new 52-week high of 38 shillings and 80 cents. Also, it has realized a gain of 89% since the beginning of Q2 when it started touching the pre-COVID levels. And having some thoughts around the strong performance may be as a result of a couple of reasons. First, the counter being cross-listed on its domestic bourse, and the NSE, specifically the NSE, has opened it to an increased foreign participation. Also, the group's performance for the FY20 was strong despite the pandemic. They registered a growth in their earnings per share, in their bottom line and balance sheet. Also, looking at the first quarter performance, the counter registered a sustained growth and notably a 79.2% year-on-year growth in its bottom line. And last but not least, at their AGM held on 16th June, a 50% dividend payout on net interest was approved for FY21, which is some exciting news for income-oriented investors. Other notable counters that were on a stellar run were Uchumi, Standard Group, Sanlam, and BOC Kenya. NBV dwindled 15% during the week, closing at 5 shillings and 92 cents. Home Africa, Car and General, Olympia, and Uchumi also under spot in the week's top losers. Looking at the foreign participation, foreigners accounted for 34.3% of the week's turnover. They had an overall net inflow position of 671.7 million and accumulated on Safaricom and Equity while exiting on EABL, KCB, and BAT. And this was the second week in a row when local investors exerted their dominance in the bourse. We closed the week on Friday with Limuruti financial results for the 6-month period ended 30th June 2021. The counter reported an improvement in its earnings per share from a loss of 4 shillings and 16 cents to a loss of 3 shillings and 58 cents. The improved performance, though in a negative territory, was driven by the cost-effective measures undertaken by the company during the period under review. Also, turnover declined 7.9% year-on-year to 46.6 million. The decrease was attributed to the declining tea prices and the lower production volumes. During the period under review, the company manufactured 433 tons of black tea, which was about 6% year-on-year decline when compared to the first half of the previous year. The earnings before tax improved 26.3% year-on-year, though stuck in the negative territory at a loss of 8.4 million. Loss attributed to shareholders was reported at 8.6 million on an income tax charge of 225,000. The company's balance sheet shrunk 3.1% year-on-year to 221.3 million, and it closed the period with a reduced cash position of 485,000 against the 5.4 million in the previous half. And the board did not recommend an interim dividend. Also, looking forward, the key drivers for the next half year will be heavily dictated by the tea prices that are currently low and the company's cost-effective measures and initiatives to ensure a maximization of returns. Looking at the Sub-Saharan market performance, the NSE, the Nairobi All Share Index outperformed its peers on a week-on-week median of 0.6%. The market price to earnings ratio was above the African median multiple of 10.3, while its dividend yield was below the median of by about 2%. Looking at the corporate calendar, in the book closure of Stanbic Holdings, 1 shilling and 70 cents interim dividend will be on 6th September 2021. To you, Melody.
Thank you, Wesley. Also to add on that, the banks are expected to start releasing the results. We've seen Stanbic had already released theirs last week, and we'll go through the results in a few minutes. So KCB Group is anticipated to report on the 18th of August and Corp Bank on the 19th of August. So just going to start looking at the financial sector highlights. So last week we saw that ABSA launched its WhatsApp banking. Now this is one of a kind, like first in kind innovation in Kenya that allows customers to access their accounts on WhatsApp and to transact. So the bank had committed 1.6 billion shillings towards automation, digitization and innovation. So this platform, it's going to use artificial intelligence and machine learning to gauge and anticipate customers' needs and requests, and consequently offer multiple solutions through the system and delivery platforms in the bank. So according to the MD, this is supposed to give clients access to a 24/7 personal digital banker who can help them perform transactions upon receiving simple instructions on chat. The same way you'd go to a relationship manager in the bank and ask for certain services. So the bank has notably taken into account data security concerns. They've installed a multi-layer approach to the platform. So first of all the traffic between the phone, WhatsApp, and it's on the back end is fully encrypted. Then the second layer is on registration. So when the bank is registering a customer, they look up the phone number, they analyze and find out if the SIM has been swapped or not, and they make sure that the registered cell phone number is the one that's actually linked to the customer's profile in ABSA. So secondly, I&M Bank received $50 million loan from IFC and FMO to boost MSMEs. That's medium-sized enterprises. So the IFC had partnered with FMO, which is a Dutch development bank, to assist small businesses in Kenya by providing them with working capital, expansion, and to just help them to weather the COVID crisis. So this loan is supposed to take 7 years with a 5-year grace period. So these conditions were given so that it could fall into the requirements for CBK's Tier 2 capital requirements. So of note also is last year, World Bank's private sector lending arm also advanced $10 million to I&M Rwanda to support the enterprises facing COVID-19 challenges. So we've seen also other banks just this year acquiring money from these multilateral development banks such as IFC, Africa Development Bank. Corp Bank had received about $75 million from IFC to facilitate lending to MSMEs as well. Equity also obtained 50 million from FMO to also give to MSMEs during this pandemic. And finally, KCB also received $150 million from IFC, Sanad, and Symbiotics. So that's also to give to smaller companies and also for client-friendly projects. So also, we note that I&M actually rolled out MSME banking in 2020. So we might see a growth in their loan book from this juncture. One second. So moving on to Cic Insurance Performance. So the group posted growth in earnings per share to 0.06 shillings from a loss of 0.13 in June 2020. So the management attributed this mostly to unwinding of the prior year's FX losses in South Sudan. So the group's equity portfolio also benefited from the recovery of the stock market, as we've seen that now the NSE All-Share Index is outperforming its African peers. So gross return premiums rose 15.9% year-on-year to 10.8 from 9.8 billion shilling, 9.3 billion shillings. Investment and other income posted an impressive 119.1 year-on-year rise to 2.6 billion, while net earned premiums was relatively flat at 7.1 billion. So the total income stood at 9.8 billion, which was up 17.6% year-on-year. Also, the expenses, total expenditure went up 11% to 9.2 billion, mostly due to increased net claims and other operating expenses. So operating expenses went up 18.5% year-on-year to 3.4 billion, and net policy holders benefits went up by 7%. So of note is that its finance costs actually went down 23.3% year-on-year to 231.8 million, as it was reorganizing its balance sheet. So the company had previously announced its intention to sell its land, which is valued at around 6 billion, to offset its outstanding loans. So the management had stated that it's actually cleared its intercompany loans. And now with this sale of land, it wants to free up funds because land is not a current asset. They want to free up the funds to acquire recurrent assets. So profit before tax stood at 336.7 million, which was up an impressive 217.5% year-on-year from a loss of 286.5 million the previous year, the same period. So after the tax of 77.3 million, net profit stood at 259.2 million. And the board of directors did not did not recommend an interim dividend. So the management has been focused on its turnaround strategy, and this is one of the reasons why they said they did not recommend a interim dividend, as they're still coming out from their loss position. So as the year progresses, they'll see if they'll recommend an interim dividend at the end of the year. So they've been looking into digitization, cost optimization, as well as operational efficiency. We also saw that they made leadership changes to both the senior management and the board level. So they had earlier this year launched a claim service portal for its garages and assessors. So it's supposed to automate the bidding system, aiding garage owners to respond to bid invitations from CIC. Also, it's supposed to help in confirming receipt of repair vehicles at garage, initiate release, and aid in reinspection of motor vehicles. So it's also going to track the turnaround time and improve the documentation of garages. So as we move on to Stanbic Holdings performance, so we saw that it reported a 37.2% year-on-year rise in its earning per share to 8.86 from 6.46 during the same period last year. The company's asset base shrunk though by about 8.8% to 329.5 billion. So the management attributed this mostly to a decline in loans and advances, which was 11.7% year-on-year decline to 207.6 billion. Its deposits also went down 9.4% year-on-year to 260 billion. And the borrowings went up marginally by 1.1%. So the group had made the active choice to retire some of its expensive dividends, and now it's going to focus mainly on growing its current and savings accounts. So net interest income went up 9.5% to 6.9 billion, while non-interest revenues went up 10.5% to 5.5 billion. So management also attributed this to increase in foreign exchange income trade, as well as investment banking fees. So the mobile and fee waivers were offset with the growth in fees in trading and investment banking. So basically, the total income stood at 12.4 billion, which was a 9.9% year growth. Something else is that the credit impairment charges, this is the loan loss provisions, declined by 24.2% to 1.5 billion, while total operating expenses went up 17.6% year on year to 6 billion. So the group noted that it had invested 624 million in new technologies. For example, it introduced digital lending, digital customer onboarding, and also its app called Stansure that will help customers to purchase and renew motor vehicles on this app. So due to this reduced impairment cost, the net profit stood at 3.5 billion, which was 37.2% year on year higher than the previous period, to close at with the profit after tax closing at 4.1 billion. This was after a tax expense of 1.3 billion. So the board of directors, as Wesley had mentioned, had recommended an 1.7 shilling interim dividend for the 6 months ending 30th June. And that's supposed to be paid on the 27th of September with a book closure on 6th of September. So of note is that the group had last year paused payment of interim dividends, and this year it has proposed. So it looks like things are shaping up well for the next few quarters to come. So let's see how it goes. And finally, we go to the trading idea of the week, which is a buy on ABSA with a target price of 11.94. So as we've noted earlier, it had launched its WhatsApp banking platform, which is supposed to assist it to boost income as well as cost optimization. And because traditionally ABSA used to pay dividends, it's just that last year, due to the pandemic, it withdrew its dividends. We see this, that it's going to anchor back the option of a dividend play. So looking at its performance in Q1, when the EPS went up, that's earnings per share, went up 23.7%. We expect this performance to continue in the coming quarter and in the year, the full year. So that's it on our end. Back to you, Churchill.
Thank you very much, Melody, Wesley, and Churchill for the presentation. And we have questions. Peter Ndungu is asking, do I get emailed the presentation slides after this webinar? Yes, you will have a link will be sent to your email after the presentation, once the presentation is uploaded on YouTube. And Cliff Mayaka is asking, what is a tap sale?
Thanks, Dan. Let me pick that one. So ideally, let me just walk you with some examples so that you can be able to be on the same page. Assuming like this particular August primary bond, where CBK was seeking 60 billion, and then it received, say, bids worth 40 billion, which say it accepted 40 billion, but then it wanted 60 billion. So there are two ways out of that. It can either issue a tap sale, so this is the crux of the question, or it can either reopen the bond. So those are the two options, either tap sale or reopen those bonds. So by a tap sale, because the results of that particular auction is out, like we saw with the yields for the 3 bonds are out. So ideally for a tap sale, it's they just want people to fill up that bid, that deficit of 20 billion. But now the bids that they will take is already been set at that particular auction that closed where they raised 40 billion. So tap sale is just a way of CBK at least more or less containing the rates where they are, but just attracting the bids, the difference of the bids that they were looking at. So that's the tap sale. But now for, if it opts for a reopening, basically now, or a new issue, so basically as opposed to the purchasers of that bond, as opposed to taking the bids that were there, people now put up fresh bids afresh. So that's made the main difference between a tap sale and a reopening. So tap sale is whereby there's a sale that was there. The yields of those bonds have already been determined, whereby initially there was the weighted average of bids that were placed and then the weighted average. So the weighted average is now, if you are participating in the tap sale, ideally you are subscribing to that weighted average that was accepted in the initial primary. So that's the main difference, or that's what separates a tap sale with other sales that are out there.
Okay, thank you very much, Churchill. Another question is, we saw Safaricom touched its highest point yet in terms of the share price. Are we likely to see it rally higher, or we are likely to see it drop from where it is?
Well, for Safaricom, looking at, let's say, the M-Pesa revenues, which are projected to accelerate on the back of a strong growth in their 30-day active M-Pesa users, and also looking at the fact that there is a lapse in the zero rating, it means that the revenues that will be realized will be much higher. So you find there are very many prospects for the growth of Safaricom. Also looking at the launch of the M-Pesa Super App, which is expected to revamp the M-Pesa usage on the back of the growing active 4G devices in their FY21, that is expected also to rise in the current financial year. Also, the venture into Ethiopia through the consortium-led operating company is a long-term project with opportunities in voice and data, considering the low mobile penetration in Ethiopia, which is about 43% teledensity. And it also goes without saying that the country is projected to profit heavily from the untapped mobile money businesses on the regulation by the green light. Looking at all these factors, you probably can see that there are very many prospects for Safaricom to grow in the future.
Okay, thank you very much, Wesley. I think I have one last question for Melody. What should we expect in the results that are about to be announced by banks in the coming days?
Thank you for that.
Sorry, I've put you on the spot.
I think with the results that we've seen in the first quarter, it's like an indication of what's to come, especially now that some restrictions have been relaxed. You remember that as of March, there was that time that there was some reintroduced restrictions. Now that those have been lifted, it's expected that this quarter too will see improved performance. Also, we've seen mostly banks are now leveraging on their digitizations. We've seen now, like the way ABSA is venturing into new projects in its digitization. We've seen Standard Chartered as well. Equity, KCB are also heavily invested in digitization, with around 98% of transactions actually being done on alternative channels. Also, banks are looking to reduce their costs. We've seen the loan loss provisions in the first quarter actually came down for some banks, with the exception of Copbank. So maybe we'll see, with this reduction of loan loss provisions, we'll see expenses also coming down, and this can also now move the bottom line rather. So, and also because now the loan restructuring window was closed, we expect now that the suspended interest income that was held back during that duration will now start being paid. Now that's also going to come into play with the interest income. I hope I've answered it. as well as required.
Yeah. I think now I know what to expect. Eric Kombok is asking, the FTSE NSE 25 share index looks set to gain for the fourth day today. Top gainers including during this period are Uchumi, KCB, and Equity. What is the outlook on the earnings of the top gaining stocks?
So for KCB and Equity, I'd say that the outlook is rather good. So we're just waiting to see the results that are coming up so that we can give a comprehensive answer. But based on the performance in the first quarter, we can say that it's looking like it's going to be a good quarter. KCB, because they had a slowdown in mobile disbursements in the first quarter because they were moving to their new Vuma platform. And they had, in the management, they had said that they're going to now resume disbursements. And also, yeah, I think that's also, there's a prospect of the acquisition for BPR, that's Bank Popular de Rwanda, and Bank ABC in Tanzania. So hopefully if those transactions go through, they'll see their deposits go up, the balance sheet go up, and also generate income from these acquisitions as well. So we're just waiting to see how it goes, but we have a positive outlook to those two counters. For Chumi, I can't really say much on that. Haven't really covered that at the moment, but we can look into it.
Okay, thank you very much, Melody. Peter Ndungu is asking, why are NBV shares prices very volatile?
Well, let me try answer that. For NBV, I think for the longest time it has been pricing in news and announcements. Initially, there was this announcement of Delta acquiring 84% stakeholding for 83 million thereabout, and then there was announcement on business restructure, and investors really speculated on that on the hope that something might materialize out of it. Then there was the announcement of acquisition of 11.33 hectares of land in Mavoko for a future setup of a cement manufacturing facility, acquisition of 100% acquisition of Air Direct and Aviation Management Solutions, and also acquisition of Delta Automobile, which maintains heavy commercial vehicles. So when these announcements were out, investors had much to speculate on. But then there's been this silent window as people wait for the go ahead by the CMA, by the shareholders, and by the NSE. So I think that lag of information, there is nothing more to speculate on. So the shares reflect that in a way. Melody or Sam, may you have something to add on that?
I think Chris, you've touched on the drivers around the price gyrations on NBV. This is a stock that was restructured. We saw the restructuring. It was announced October last year. It was affected in December. So when it came from suspension, we saw it coming up from 71 cents, and then it spiked to 5 shillings. 31 cents. That's around 4th December when it was reopened. And then there's been a multi announcements in the company. One, this acquisition or these acquisitions of other companies. So we are seeing NBV, which traditionally has been more or less like a retail shoe, a shoe retailer company, now pivoting into something close to a conglomerate, getting into, I think, transport logistics, into a cement company, and also some of the aviation companies that they're trying to bring on hold. But then fundamentally, people are seeing that there's a cost to it. I think the total cost that was attached on the acquisitions of these 4 companies that was announced in July, it was around 3 billion shillings. Then there's a cost, I think 15 billion of now coming up with the cement factory under the wings. So I think people are trying to see, okay, this is a company that even if you look at its market cap, or rather its equity position, it wasn't something that, the questions that are coming is, okay, how will they be able now to execute this big ticket deals. So I think that is now what is being reflected in the price, which is now more or less on a negative spiral as compared to an upward spiral that was there once the first restructuring was announced sometime last December. So we still expect some volatilities. I think there's a delay in publication of its financial results. We're expecting it to be done by the end of this month. Probably it will give us some glimmer of what exactly will be resulted from this pivoting from what we know in BV as what it was to where it is going to be. So that's something that we are still monitoring as market participants on this particular counter. So back to you, Dan.
Okay, thank you very much, Churchill, Wesley, and Melody for the presentation today. Should you want to start trading or execute your trades, you can do so through our application, that is Jikuze, which is available on the Google Play Store and Apple Store. And we'd like also to thank you for setting apart this time and logging in to this webinar. And we'd also like to wish you the best in your trades and the executions that you're going to do this coming week. And we hope to see you next week. Thank you very much. And that's goodbye from us.